All right, yield nerds, I see the turbulence in the market and I'm getting excited. I think there is a strong bull run for those who are ready to be patient. I will tell you how I am approaching it, and you do you. We are up to 361 subscribers. Thank you for your support. If you're new, please remember to use the Income Investing Roadmap. It's a playlist that organizes this show. Most importantly, I do not have any magical powers. I do not pull rabbits out of hats. Make sure you do your own homework. Well, let's look at this episode in four parts. We'll, as always, look at the market temperature. I'll share my portfolio, how it is doing, and we'll do the Yield Superbowl because that is that season. It is going to heat up the next 90, 100 days. I'll give you my fixed income thesis and then share with you the trades that I made. There is obviously a Yield Super Bowl happening between the Bulls and the Bears in front of the New York Stock Exchange. You can see that unveiling right there. Well, my portfolio itself is coasting along. I don't really have giant ups and downs, as you know. I am very, very strongly in fixed income for a certain reason, and I'm slowly venturing into equities. And even when I do venture into equities, I have very strong preferences towards value equities, at least in this time. And these are, things like eggs and gas and food and things like that that we're going to need no matter what the economy is doing. I also play very heavily in treasuries, T-bills to be specific, because I expect equities to crash more, not less, between now and the election. And I do intend to get into equities. I'm just choosing my time. So Yield Super Bowl is a good game to play right around this time, right after Chairman Powell speaks, and it certainly has changed a lot. Before I go further, I want to make sure I clarify that this is not tax advice, this is not wealth management advice, and I don't do politics or products, and I'm not pitching anything. I'm just sharing my education, you do you. Well, we're going to do a little bit of Treasury time travel. I'm going to remind you of what we did before. We started in May 2023. The yield curve looked like that, very short term, looking north of 5%. And wow, how did the world change in about 5 months? The peak, absolute peak of the market was around October 2023, when you could make 5.5% short term and 5% long term. That was just absolutely insane. The market started coming down as anticipation of a decrease in interest rates started building. Barely 4 weeks ago, you could still make kind of sort of close to 4.5%. And boy, have the tables changed. And here is where the yield curve is today. Here is May 23, and the very top line is October 23. We are practically crashing and burning our way back to May 2023. And I sometimes look at that and say, gee, I wonder what we would do, if we have to address and service all that debt. This is the American debt, and we have a ton of debt. And when that debt matures, it has to be parked somewhere. If the government takes a huge chunk of that debt and finances it on the very long end of the curve, it has a problem because it has to pay this enormous interest rate for a very long time. If, however, the government comes in with too much debt at the beginning, there is a different problem because demand may not be as high, which means the price will be driven up. So the government is doing a little bit of, how do I do this smartly? Where do I put the bulk of the debt? Except as debt matures, more and more debt needs to be refinanced. It could be refinanced, I suppose, in one of two ways. We could increase taxes, probably not going to happen in an election year. We could decrease spending by cutting benefits, also not going to happen in an election year. Or we could go back to the debt market, pretty much the only choice right now. And so when all that debt comes in, the Fed has to think about what do I do and where do I service that debt? Now, if the Fed had a magic wand, they would want a curve that looks something like this. I mean, I don't know if this is exactly what they would want. I'm not Chairman Powell, but they would want a straight line. They certainly wouldn't want an inversion. And they would say, we're going to put some amount of debt in the low end, and hey, we will pay you more for holding the longer term debt, but not, a crazy high amount. And so that's kind of sort of where you would imagine things are headed. But as you can see, there is this huge gap between where we are and where we need to be. And the Fed cannot dramatically drop the interest rates like that, because if they did, and they still kept financing a whole lot in the short term, then people would dump U.S. treasuries and go to higher paying and fixed income instruments internationally. So that's not going to happen. So there's a little bit of a dance, and you also don't drop interest rates until the markets are in trouble and the economy is in trouble. So the game is to try and anticipate and figure out when you want to own equities, because you certainly don't want to own 2% treasuries, and figure out how to get your income in the right track. And that's what I attempt to do. So let's play Yield Super Bowl and see where we end up, as we start bumping up treasuries and bumping up agencies. And I'm skipping through all the rules, and you should refresh yourself with other Yield Super Bowl episodes from before. And I also don't use marginal tax, which, you don't pay a different tax in your last dollar. You pay the same kind of tax. You may remember in November 2023, treasuries were the name of the game. There were some munis that showed up, surprisingly. And look at these munis paying 6 and 7%. But when I investigated those munis, you may remember these were banks that didn't have enough money, and I just didn't feel comfortable owning those munis at that time. And so it just seemed like it was a treasury and a bunch of other stuff. Agency bonds really weren't up there. And all of a sudden, in August, we have a very different ball game. We have treasuries, but they don't pay the kind of money that you would look for. And then you have a whole slew of agency bonds. And the agency bonds, however, are callable. The risk with the callable agency bond is you buy these 2, 3, 4 years thinking you've locked in your interest rate. The moment the Treasury drops interest rates, they call those bonds. And now you can't make enough money on treasuries, and you don't really have your longer duration. So callable agency bonds are nice while it lasts, but you always need to be aware of allocating too much. And so I kept looking at, gee, where can I go? Where can I park my money for the 2 year or longer duration? And I started getting interested in munis, and I'm going to share with you my research. You do you. So here is my fixed income thesis. Callable munis. When you buy a muni, you got to be very careful. Here are some munis that pay a 5% coupon. Now, the coupon is not what is tracked in the yield curve. Thank you. Because the coupon is irrelevant. I could give you a 10% coupon and say, pay me a par value of 150 on a $100 par, or pay me a price of 150 on a $100 par, and you'd be the loser. And so what really is plotted is yield to maturity, meaning if you paid $100.61 for a bond that's at a $100 par, then you're not making really the 5% they are promising. You're making more 4.92. That's all well and good. The challenge is if that bond gets called one day after you bought, you're not even making 4.9, you're making more like 3.48. I wish what was really plotted was the yield to worst, and that is not being plotted. And so be careful buying munis above par, or anything above par for that matter, but munis are generally the ones that trade above par. And so I looked at some of these munis that started showing up at the longer duration, and I wasn't too excited about the munis that are trading above par. And so I started dumpster diving. I started looking at munis that are trading really, really below par. Here is one, for example. This pays a coupon of 3%. That's nice. It is a 20-year muni, so there's another 20 years left on this. 3% for the next 20 years. Now remember, the Fed pays something of the order of 4% for the next 10 years. So this is 3%, but here is the kicker. This is trading at 72 cents on the dollar, which means you can buy $10,000 of this bond for $7,000, give or take. And so what does that do to your yield to maturity? Your yield to maturity is 5.1. How about that? So you can lock in a 5.1% yield to maturity. Now, there are problems with buying muni bonds. These bonds may not get paid, so I don't want to, please make your own decision. But this is a bond that is trading way underwater. 3% of that 5.1% is not federally taxable. The other 2% is ordinary income, so you got to make sure you take that into account as well. So I started diving deeper into what is this bond and why is it trading like that, and is that something I would consider? And there is another fancy word here, OID. That means it's an original issue discount, which means when they issued the bond, they did not issue it $100. They issued at something lower than $100, and they said, buy this, and when we buy it back from you, we'll buy it back from you for $100. So there is an extra kicker built in as well. So there's a lot of interesting things here. So let's understand this muni bond. This bond is issued in Barnes County, North Dakota, which is, in the Valley City is the name of the city in that county. And it is a county with a population of 10,000, a fairly small county for many other parts of the country, but in North Dakota, I suppose that's a reasonable size. And a couple of things about the county, and I'll post references to all of this in county statistics in the Yield Nerd episode. So it turns out that county is actually on the upward trajectory. Their weekly wage is increasing, their business establishments are increasing, and their per capita income is on a very nice upward curve. And I started looking at all of those going, that's interesting. That county seems like, even though it only has a population of 10,000, it seems like it is economically stable. And so why are they issuing a bond? Well, it turns out they have a small problem. The county has a county jail. The county jail is 120 years old, and it is dilapidated to the point where the government said, hey, you can't keep people in a jail that's falling apart. You got to build a new one. And so we are going to decrease the occupancy limit. I didn't even know there was such a thing. I started reading the supplementary information of this bond to learn all of this. Turns out that there are jails that are grade 1 and grade 3, kind of like eggs that are grade 1 and grade 3. And if you're downgraded, you cannot keep inmates for a long term. And this jail was downgraded from keeping inmates for a year to only keeping inmates for 48 hours. What do you do when somebody has done something really bad and they need to be there for longer than 48 hours? You transfer them to another county jail, which may be an hour away. And they said they spend more than $200,000 plus paying for the transport, plus the labor of the person who's transporting them. And so they said, we're paying $200,000 a year every year. We got to rebuild that county jail. We need a jail in our own county. And as you saw from the previous page, the county is fiscally doing reasonably well, all things considered. And so they raised $15 million in a bond. They wanted to pay that 3% coupon with an original issue discount. They issued the bond in the year 2021 during COVID. 3% was a fine number, except the bond has crashed now because everything pays 5%. So the yield to maturity is 5 right now. And the county said, if we can't service the bond, the 3% coupon, then we'll pay you through sales tax. The only condition that this bond will go underwater is if we don't complete construction of the jail. They said that in the year 2021. Ta-da! Here is the scenic jail. Apparently, it's very scenic. And it has 46 beds. They've finished construction. 20 inmates are there. I just checked that because I had nothing better to do. They have outstanding warrants for 100 people, so it looks like the jail will have some kind of good occupancy. And the nearest county jail is 1 hour away, which means anybody that is, needs to be incarcerated in that radius is going to go into this county jail. And I started understanding this bond even more, and a couple of things popped up. The current yield is more 4%, not 3%, for the simple reason that the $100 par is trading at $72, which means the yield is bumped up from a 3% coupon to more like a 4.1, except if you held this to maturity, the $72 becomes $100. And so you really get 5%. What's even better is if they call this bond, now I don't think this county can afford to call this bond because they'd have to come up with $15 million and it's a 10,000 person county. But if they did call the bond, you would make a yield to call of 51%. And so, you do your math. I thought that was an interesting bond there, an interesting exercise. I'm going to keep looking for more muni bonds. So here is my play. For now, I'm still going to be in significant T-bills and callable agencies. As interest rates drop, I am gravitating to munis, but only cases where I believe the issuing authority is fiscally stable. And there again, I'm also going to look for value, meaning I'm not going to buy a muni to build a hotel in this economy. If it is a prison, it seems like it's a value investment. You need prisons in good times and bad. I do believe the election will introduce volatility. I do believe there will be a dip in equities. I don't know when, but it seems like it. And so I'm just going to be patient and wait for a dip in equities. In the meanwhile, I'm going to shift to slightly longer durations and also, keep a lot of liquidity so I can jump into the market. So here are my trades. My boring portfolio generally keeps going up because I'm not into the wild equity ride. Speaking of the wild equity ride, here is where the markets are going up and down like crazy. And I saw something that I wanted to share. The last month for NVIDIA is a downward trend. Guess what the upward one is? That's CalMaine Foods. And so the idea of being in the value side when we head in towards a lot of volatility, at least in the CalMaine scenario, is proving out. And my trades have been very straightforward, still Red Cat and CalMaine and treasuries. And yes, I bought my first Muni, you do you, Barnes County Correctional Facility. I now officially own that place. If you plan to commit a crime, I highly recommend you do it in Barnes County. I'm counting on a higher occupancy there. Just kidding. Well, as it stands, here are my equity holdings that are in the positive. I do have duds, including Intel, but I don't have a big position. So overall, I'm still up on my equity portfolio. Please remember, even a broken clock is right twice a day. Do your own homework. Thank you.